Hey there, financial navigators, and welcome back to the channel where we demystify the markets. Today, we're diving deep into a fascinating corner of the market, focusing on a stock that's showing up on our hard to borrow screener with some truly eye-popping metrics, SPHL, or Springview Holdings Limited. We're going to break down what makes this stock hard to borrow, what that means for potential short squeezes, and what you need to understand before even thinking about these types of plays. But first, remember this. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Alright, let's talk about Springview Holdings Limited, ticker SPHL. Short SPHL logo / chart. This company operates in the consumer cyclical sector, specifically in residential construction, primarily designing and constructing residential and commercial buildings in Singapore. They handle new construction, renovations, and general contracting. SPHL is a relatively small player with a market cap of just $7.01 million. Now for the recent action. SPHL has seen some significant movement lately. Today alone, it's up plus 5.74%. Looking at the past 5 days, it's climbed a solid plus 20.38%, and over the last 30 days, SPHL has gained an impressive plus 24.20%. Show price chart. This price momentum is backed by some serious volume. Today's volume hit 4,886,666 shares, which is 2.4 times its 30-day average volume of 2,056,972 shares. Clearly, something is attracting attention to Springview Holdings Limited. What is cost to borrow and why it matters? So, what does it mean for a stock like SPHL to be hard to borrow? When someone wants to short a stock, they first need to borrow shares from a broker. The broker charges a fee for this, called the cost to borrow, or CTB. This is essentially interest paid by the short seller for the privilege of holding a short position. When a stock becomes hard to borrow, it means there are very few shares available to lend out, and demand from short sellers is high. This scarcity drives the CTB fee sky high, sometimes exceeding 100% on an annualized basis, as we're seeing with SPHL. Why does it matter? Because a high and rapidly increasing CTB is like a pressure gauge for short sellers. It adds significant carrying cost to their position, making it very expensive to stay short. Why this stock is hard to borrow right now? Now let's get specific about SPHL. Highlight CTB or screener flagged Springview Holdings Limited because its annualized cost to borrow fee is an astronomical 742.0%. To put that into perspective, that's almost 2% of the stock's value per day just to hold a short position. What's more, the CTB has seen incredible momentum, surging by an additional 273 percentage points over just the last 5 trading days. This rapid increase tells us that the availability of shares to short for SPHL is shrinking extremely fast. In fact, as of our last check, there were only 3,000 shares currently available to borrow. Zoom in on shares available with an estimated float of 1.2 million shares for SPHL. Having only 3,000 shares left to borrow means that very little inventory remains for new short positions, or even for existing short sellers to cover if they wanted to. Our internal composite squeeze score for SPHL is currently 42.8 out of 100, reflecting this cocktail of high CTB, shrinking supply, and recent price and volume momentum. Squeeze mechanics explain. This scarcity of borrowable shares, combined with an exorbitant CTB, is precisely what can set the stage for a short squeeze. Imagine this: short sellers borrow shares of Springview Holdings Limited and sell them, betting that the price will go down. If the price starts to rise instead, perhaps due to positive news, increased buying volume like we're seeing, or just general market sentiment, those short sellers face a dilemma. Not only are they losing money as the stock price increases, but they are also hemorrhaging cash due to that 742.0% cost to borrow fee. If the price continues to climb, and they face margin calls from their brokers, they are forced to buy back shares to close their positions. When many short sellers are forced to buy back at the same time, it creates a cascade of buying pressure, further driving the price up, which then forces even more short sellers to cover. This vicious cycle for short sellers is the essence of a short squeeze. Dilution risk check. It's crucial to understand dilution risk when evaluating potential short squeeze candidates. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. While a high cost to borrow might signal a squeeze, new share issuance can flood the market, negating the scarcity that drives a squeeze and putting downward pressure on the stock price. For SPHL, we checked for recent dilutive SEC filings like -1s, -3s, or 424 BS over the last 90 days, and found no evidence of new share offerings. We also confirmed there has been no recent reverse split for Springview Holdings Limited in our look-back window. This means that, from a dilution standpoint, the current share structure isn't immediately working against a squeeze thesis for SPHL. Before we talk about what to watch for, let's quickly reiterate this. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For Springview Holdings Limited, keep an eye on a few key metrics. First, continue to monitor the shares available to borrow. If the 3,000 number drops further or stays consistently low, it indicates continued pressure. Second, watch the CTB momentum. Any further rapid increases in that 742.0% fee would signal even greater urgency for short sellers. Third, pay close attention to SPHL's volume and price action. Sustained high relative volume and continued upward price movement could trigger more short covering. However, it's vital to remember that a high cost to borrow does not guarantee a short squeeze. Sometimes short sellers have very strong conviction that a company like SPHL is overvalued or facing fundamental challenges, and they are willing to pay extremely high fees to maintain their short position. So, there you have it, Springview Holdings Limited, SPHL, a small cap player in Singapore's residential construction market, currently exhibiting some incredibly tight borrow conditions with a 742.0% CTB and a mere 3,000 shares available. This makes SPHL a prime example of a hard-to-borrow stock that could potentially be ripe for a short squeeze, but it's not a guarantee. This is a highly speculative area of the market, driven by supply and demand mechanics. Always conduct your own thorough due diligence. What do you think about SPHL? Let us know in the comments below. If you found this explanation helpful, smash that like button, subscribe for more in-depth market breakdowns, and hit the notification bell so you don't miss our next video. Thanks for watching, and we'll see you next time.